Imagine this: 3 different people. Each person invests 100,000 pesos. 10 years later, the first investor has been receiving cash every single year without selling a single share. The second investor watched the value of the investment more than double. And the third investor simply invested in the market, did almost nothing, yet still built significant wealth over time. Surprisingly, none of them made the wrong decision, because each of them followed a different investment strategy. So, here's the question. If all 3 became successful, which strategy should you choose? Should you invest for passive income? Should you focus on high-growth companies? Or should you simply invest in the entire market and allow time to do the work? Today we are going to explore 3 of the most popular investment strategies used by investors around the world: dividend investing, growth investing, and indexed investing. We'll discover how each strategy works. We will use real Philippine companies as examples. And by the end of this lesson, you'll understand how each strategy works, its advantages and risks, and which one may be the best fit for your own financial goals. Now let's begin with one of the most popular investment strategies in the world: dividend investing. Many established companies choose to pay dividends because they already have stable earnings. These companies are often well-established businesses with predictable cash flow and years of operating experience. Let's look at a few real examples from the Philippine Stock Exchange. Our first example is DMCI Holdings. DMCI Holdings has built businesses in construction, real estate, mining, power generation, and water utilities. For many years, the company has been recognized by investors for its history of paying cash dividends. Although it's important to remember that future dividends are never guaranteed. Now let's look at a simple example. Imagine you own 1,000 shares of DMCI. Suppose the company declares a cash dividend of 2.20 centavos per share. How much would you receive? 1,000 shares multiplied by 2.20 centavos equals 2,200. That money would normally be credited directly to your brokerage account on the scheduled dividend payment date. But here's something many beginner investors don't realize. Dividends are only one part of your potential return. You may also benefit if the company's share price increases over time. For example, suppose you purchase DMCI at 10 per share. Several years later, the market price increased to 13.50 centavos per share. That means your investment gained 3.50 centavos per share. For 1,000 shares, your unrealized capital gain would be 3,500. Now let's combine both sources of return. You received 2,200 through cash dividends, and your investment increased by 3,500 through capital appreciation, giving you a total potential return of 5,700. Regular cash dividends and long-term capital appreciation. Another example is Manila Electric Company, better known as Meralco. Meralco is the country's largest electric distribution company. Every day it supplies electricity to millions of Filipino homes. Because electricity is an essential service, Meralco has built a reputation as a stable business. This is one reason many long-term investors continue monitoring its dividend history. Let's look at another example. Imagine you own 1,000 shares of Meralco. Meralco declared a total cash dividend of approximately 21.52 centavos per share. If you own 1,000 shares, your total cash dividend would be 21,520. But dividends are only one part of your potential return. Suppose you purchased Meralco shares at 300 per share. Several years later, the market price increased to 360. Your investment gained 60 per share. For 1,000 shares, your unrealized capital gain would be 60,000. Now combine both returns. 21,520 from dividends, plus 60,000 from capital appreciation, giving you a total potential return of 81,520. Our third example is PLDT. PLDT has been serving Filipino consumers and businesses for nearly 100 years. Because communication has become an essential part of everyday life, PLDT has become one of the Philippines' largest publicly listed companies. Over the years, the company has also built a reputation for distributing cash dividends to its shareholders. Let's look at another example. Imagine you own 1,000 shares of PLDT. Suppose the company declares a cash dividend of 100 per share. Your total cash dividend would be 100,000. But remember, dividends are only one part of your investment return. Imagine you purchased PLDT shares at 1,200 per share. Several years later, the market price increased to 1,400. That represents a gain of 200 per share. For 1,000 shares, your unrealized capital gain would be 200,000. Now let's combine both returns. 100,000 from dividends, plus 200,000 from capital appreciation, giving you a total potential return of 300,000. These examples show us why many investors appreciate dividend-paying companies. They may receive regular cash income, while also benefiting from the company's long-term growth. However, always remember this important lesson. A company that pays dividends today does not guarantee that it will continue paying dividends in the future. Business conditions can change. Profits can increase or decrease. Economic conditions can affect earnings, and a company's board of directors may decide to increase, reduce, or even suspend future dividend payments. Always do your own research before investing. Before we continue, I'd like to remind everyone that the company's sample computation stock prices and investment returns shown in this video are for educational purposes only. The figures used are simplified to make the concepts easier to understand and easier to visualize. They are not investment recommendations. Now let's move to another investment strategy, growth investing. Unlike dividend investing, growth investing doesn't focus primarily on generating cash income. Instead, growth investors look for companies that have the potential to become much larger over time. These companies often reinvest a significant portion of their profits back into their business. They open new branches, develop new products, enter new markets, acquire other companies. The goal is simple: grow the business and over time increase the value of the company. Let's look at several real Philippine companies that many investors associate with long-term growth. Our first example is Jollibee Foods Corporation. Today, Jollibee is recognized as one of Asia's largest restaurant companies. But it didn't start that way. Jollibee began as a small ice cream business during the 1970s. In 1978, it officially became a fast food restaurant company. Instead of paying out most of its profits as dividends, the company continued investing in expansion. It opened more stores, entered new countries, and acquired well-known restaurant brands, including Chowking, Red Ribbon, Coffee Bean, and Tea Leaf. Every acquisition helped the company serve more customers and expand its global presence. Now let's look at a simple example. Imagine you invested 150,000 by purchasing 1,000 shares at 150 pesos per share. As Jollibee continued opening new stores, acquiring new brands, and expanding around the world, investor confidence also increased. Suppose the share price later increased to 300 per share. Your investment would now be worth 300,000 pesos. That means your investment grew by 150,000 pesos. Notice something important. That return didn't primarily come from dividends. It came because the business itself became more valuable. That is the main idea behind growth investing. Our second example is SMPH Holdings. SMPH is one of the largest integrated property developers in the Philippines. Many people know the company because of its shopping malls, but today its business extends far beyond malls. It develops residential communities, office buildings, hotels, convention centers, and large mixed-use developments. Instead of simply maintaining its existing properties, SMPH continues investing in new projects, building new communities, expanding its real estate portfolio, and creating new opportunities for long-term growth. Let's look at another example. Imagine you invested 200,000 pesos by purchasing 10,000 shares at 20 pesos per share. Over the years, the company continued expanding its developments, increasing its recurring rental income, and strengthening its business. Suppose the market price later increased to 30 pesos per share. Your investment would now be worth 300,000 pesos. That represents a gain of 100,000 pesos. Again, this illustrates how investors may benefit when a business continues expanding over many years. Our third example is Monde Nissin. Monde Nissin is one of the Philippines' leading food and beverage companies. Many Filipinos grew up with brands like Lucky Me, Skyflakes, and Nissin. But the company didn't stop building those successful brands. It continued investing in product development, innovation, manufacturing, and international expansion. One of its largest investments was the acquisition of Corn Foods in the United Kingdom. Growth investors often pay attention to companies like Monde Nissin because they continue looking for new opportunities to grow their business. Let's look at another example. Imagine you invested 90,000 pesos by purchasing 10,000 shares at 9 pesos per share. As the company continued expanding its operations, launching new products, and growing its business, investor confidence also improved. Suppose the market price later increased to 13 pesos per share. Your investment would now be worth 130,000 pesos. That means your investment grew by 40,000 pesos. Again, the objective wasn't to collect large dividends. The objective was to own a company that had the potential to become much larger over time. Growth investing can produce excellent long-term returns, but it also comes with higher risk. Not every company will succeed. Some businesses grow rapidly, others grow slowly, and some may never achieve their expected potential. That is why growth investors carefully study a company's financial performance, business model, competitive advantages, management team, and long-term vision. Now we've learned how investors can earn through dividends. We've also learned how investors can build wealth by investing in companies with strong growth potential. But what if you don't want to spend hours researching individual companies? What if you simply want to invest in the Philippine economy as a whole? That's exactly what we'll learn next. Before we continue, I'd like to remind everyone that the companies and sample computations shown in this chapter are presented for educational purposes only. Welcome to Index Investing. Unlike dividend investing, where you choose companies that regularly pay dividends, or growth investing, where you look for companies with strong growth potential, index investing takes a different approach. Instead of choosing just one company, you invest in many companies at the same time. In the Philippines, one of the most widely followed stock market indices is the Philippine Stock Exchange Index, or simply the PSEi. The PSEi is composed of 30 of the largest, most actively traded and well-capitalized companies listed on the Philippine Stock Exchange. These companies represent different sectors of the Philippine economy, including banking, real estate, retail, telecommunications, utilities, industrials, and consumer goods. Some well-known companies that have been part of the index include BDO Unibank, Bank of the Philippine Islands, SM Investments Corporation, SM Prime Holdings, Ayala Corporation, Jollibee Foods Corporation, Globe Telecom, and many other leading Philippine companies. Now let me ask you a question. If you had 100,000 pesos to invest today, which company would you choose? Would it be BDO, Jollibee, SM Prime, PLDT, or perhaps another company? The truth is, no one can consistently predict which company will perform the best every single year. Even professional investors don't get it right all the time. And that's exactly why index investing became so popular. Instead of trying to find the next winning company, you invest in the market itself. Let's look at a simple example. Imagine you invest 100,000 pesos into a fund that tracks the PSE index. Instead of putting all of your money into just one company, your investment is automatically spread across largest and most established publicly listed companies in the PSEi. If one company has a difficult year, another company may perform very well. This helps balance your portfolio. This is called diversification. Diversification doesn't eliminate risk, but it helps reduce the impact of relying on a single company. As Philippine businesses continue growing over many years, the overall market may also grow. And because your investment follows the market, your investment may grow along with it. This is one reason many financial experts recommend index investing, especially for beginners. Because it's simple, diversified, easy to understand, and it doesn't require constantly researching individual companies. However, there's one important thing every investor should remember. Even index investing carries risk. The stock market will experience good years and difficult years. Prices will rise and prices will fall. Economic conditions, interest rates, inflation, global events, and investor sentiment can all affect the value of the market. That is completely normal. Successful investors understand that short-term volatility is part of long-term investing. Instead of reacting to every market movement, they remain patient. They continue investing, and they allow time and compound growth to work in their favor. Like every investment, past performance does not guarantee future returns. Always do your own research before making any investment decision. Final summary. Let's take a quick moment to review everything we've learned today. Dividend investing focuses on earning regular cash income from companies that share a portion of their profits with shareholders. This strategy is often preferred by investors who want to build a steady stream of passive income while continuing to grow their portfolio over time. Growth investing takes a different approach. Instead of focusing on receiving cash dividends today, growth investors look for companies that continue expanding their business. The goal is to benefit from the long-term increase in the company's value. This strategy requires patience. Because meaningful growth often takes many years, index investing offers another approach. Instead of selecting individual companies, you invest in a diversified collection of businesses through an index that follows the overall market. This helps reduce the risk of relying on a single company, while allowing your investment to participate in the long-term growth of the market. Each strategy has its own advantages. Each strategy also comes with risks. There is no single investment strategy that is perfect for everyone. The best strategy depends on your financial goals, your investment timeline, your risk tolerance, and your personal investing style. In fact, many experienced investors don't choose just one strategy. They combine all three. They may own dividend-paying companies to generate passive income, growth companies to build long-term wealth, and index funds to achieve broad diversification. The important thing is not finding the perfect investment. The important thing is starting with a strategy you understand and staying consistent. Remember, successful investing isn't about chasing the hottest stock. It isn't about getting rich overnight. It's about making informed decisions, remaining disciplined, staying patient, and allowing time and compound growth to work in your favor. The earlier you begin your investing journey, the more time your money has to grow. And sometimes your greatest investment isn't the amount of money you start with. It's the amount of time you give it to compound. If you found this lesson helpful, please consider liking this video. Subscribe to JAC-Tv. The goal is to become financially free. This is JAC-Tv. Discipline today, freedom tomorrow. Build wealth, live your dream. Thank you for watching, and I will see you in the next video.